Are you falling victim to these common behavioral financial biases? Stick around. We're going to talk through it. So today, one of my colleagues and fellow financial advisors here at Financial Symmetry, Cameron Hendricks, is joining me. And we're describing 5 behavioral financial biases that we're facing, and then give you some ways that you can fight it. So if we jump into this first one here, it's a big one. It is the big one, generally, for most people, overconfidence. And that's basically when we perceive that our knowledge of an investment is greater to where we basically disregard data and other advice. We just stick with what we feel like we know because we know that it's going to do well. And Daniel Kahneman actually, in the book Thinking Fast and Slow, called overconfidence the most significant of the cognitive biases. It's actually the one he said he'd most like to eliminate if he had a magic wand.
We're talking to investors and people all the time when it comes to their money. And, when it comes to this overconfidence perspective, the lines that we're hearing that, kind of make us think of that overconfidence behavioral side of things is, hey, look at the history of this investment, of this stock. There's no way that it could go down. On the flip side, if I don't get into an investment, I'm going to miss out. That particular stock, that particular flavor of the week per se, is that fear of missing out. If I don't get in, I could miss out big time. But then there could also be the overconfidence fear side of things where, you may think that stocks are going down, recession's coming. I know it's going to happen. And so it's that investor wants to reduce their stocks to prevent any losses, which is kind of an overconfidence on the flip side of thinking things are going to get worse. And this overconfidence, it causes us to bet the farm on an investment, to go bigger than we need to go when it comes to a particular investment because of our overconfidence. It brings to mind some examples that we've heard over the years with the stock market. So individual stocks, companies, or just most recently with tech stocks in the late 2021, where they were all going up. You got to get on that, those tech stocks, everything's going up. You can't go wrong there. Or even the fear of missing out with, we did a podcast on GameStop, and that nobody knows what's going on. You see the fluctuations up and down with it. Well, I got to get in on it. You may think of real estate. Real estate, here in the Triangle and all over the U.S. has been, booming. Thinking about that period after the first initial rush of COVID and into 2021, home values went up a ton, and you start to lead to some overconfidence in what you want to do as far as real estate investing and in your primary home or a secondary home, those kinds of things. But those are a few examples. Another one that comes to mind would be the overconfidence that I inherited these stocks from my father, from my grandmother, whoever it is, and those stocks serve them well, and they're going to serve me well. And that's an overconfidence that stocks that were chosen are the ones that are going to continue to do the best, which isn't always the case. So, Chad, how do we combat this? What do we do with this overconfidence?
Yeah, it's tough, right? Because the studies show that people that are overconfident or feel overconfident tend to trade more as well. And we know that when you start trading more, generally that's going to cause some issues and potential performance over time. So one of the ways to fight that is just to slow down in your decision making. Many people will call it the sleep on it factor, right? Take a minute to try to understand why you're making the decision. And then also seeking that intellectual humility, which is consider that idea, what if it is wrong? What if this decision goes against you? And really that is testing your investment thesis, right? Writing things out before you make the decision so you can understand the pros and cons of how that decision may impact you. Because if you can evaluate the regret factor, many times that is a powerful motivator for acting or not acting in a circumstance and really thinking about all the potential reward or consequence that could result. And then if you back up from the very beginning, I mean, this is what we've talked about in many of our podcasts, right? Seeking good advice. And that starts with a financial plan, a written financial plan. So you understand what your goals, objectives, and desires are. What are you investing for, right? What do you need the money for? And when do you need it? And how much will you need to accomplish those goals? So those factors and inputs are much more important in the decision of how you're allocating your investment strategy, as we've talked about in our 2 episodes ago and guiding investment principles, our general investment principles. Many times you can go back to that financial plan, and that is the overlay for your investment strategy and the rules behind that. A couple ways to fight that overconfidence. And then we move into our second bias here that we tend to see with people. It's called the familiarity bias. And this is the instinct to favor what we know. It drives us basically to be loyal to the things that we're exposed to most. And the way that manifests, right, has been often associated with either having a lot of U.S. stocks in a portfolio, or like Cameron said, if you were impacted by a company stock within your family or for yourself inside of a 401k and you've seen it do really well, that can impact how we think about that, right?
Yeah, absolutely. And that's, the U.S. stocks in general over the last decade have done very well. Of course, more recent times, things may have changed, but in general, over the last decade or so, U.S. stocks have been strong. So when folks are coming to us, that's often a common thing we see in their 401k plan. It may be 100% S&P 500 or just, whatever account they have. And then, even on the company stock side, as Chad mentioned, we have a lot of clients that work for a public or private company that they have equity in that company. And, they may have seen that my company has outperformed the market over this certain time period. I'm going to keep investing there. And it's hard to think that your company could fall. Things could go downhill because you're in it day to day. You're seeing the great things that your company is producing. And, you think that's it's going to drive the stock price. But it's one where we're way too familiar with that investment. And not only is there probably an emotional tie there, that it's what we know. We know and we use U.S. companies and their products. So we immediately think of their stocks. We work and get a paycheck from XYZ company. So we immediately think that, that stock is one that we should own. And a lot of times, likely you should, but it's where we're getting too much concentration in that one area. I mean, if you think back to the lost decade that we've talked about in the past, that time period of 2000, into 2009, and the studies, if you look back at the returns, if you just held U.S. stocks that whole time period, you basically earned nothing. But if you also owned international companies, you earned more. And then more likely, if you had owned the split of the two, then you had a reasonable rate of return that you had in those years. But if you were only invested in what you're most familiar in, that was a tough time looking back over that 10-year period.
Yeah, I mean, some ways that you can fight this are taking a look at your overall allocation and understanding what are you really invested in, because many times people will come in and maybe be invested in target date funds. That's basically, a retirement savings with a year attached to the fund. And those can be invested in very different ways depending on the year that you pick and the company that is responsible for that particular fund. They even differ in how they're allocated across different what we call asset classes. But you think about, if you're mostly invested in US, as Cameron said, I mean, it's really hard to remember when international stocks outperformed because it's been so long, but it does happen. And it tends to clump together over decades if you look back at the evidence, but really understanding how you're diversified and how that, again, fits into the puzzle that is your financial plan, because we are focused more on this particular episode of those biases that impact our investing outlooks or our investing strategies. But there's tax planning strategies that you deal with. There's estate planning moves that you can take advantage of or make sure they're in place so that you're not in a bad situation down the road. Also, insurance and risk management analysis that you can do. The list goes on and on of other things that are also important within the financial planning aspect. But we're zeroing in on a couple of these biases because we tend to see this, and this is what people often are most interested in when we first speak with them, right? It's what can I do with my investments? What should I be changing? What good things have I done or what mistakes have I made and how can I change that? And that's what we're addressing with some of these biases, because if you can understand the biases beforehand, it can set you up to make better, thoughtful, evidence-based decisions within your investment strategy. So as we move along into our third one here, talking about hindsight bias, right? And this is our tendency to look back at an event that we could not predict at the time, but we think the outcome was easily predictable after the fact. And I think we've all fallen victim to this, right? Because you can look back in time. I mean, just this year, for example, right? The stock market had rallied and rallied and rallied, with the exception of COVID, right? A very quick kind of hiccup through there. We continued to experience that really good market. And we had many people starting to say, we know this is going to fall at some point. So what can we do to control that, right? So that's that instinctual feeling that you have. And then it gets stronger after the fact once you look back and remember that you might have had a slight thought about how that could happen. But talk about how we see this play out sometimes, Cameron.
Yeah, and in the stock market specifically, how I see it play out the most is with individual stocks, with particularly those that you may have received as equity compensation. Because I think when you receive it that way, you're more in tune to the price that you were granted at, the price that you exercised, the price that those shares vested. So you remember what it was worth, and if you hold on to them, now you're at a time where they're either going to be, of course, higher or lower. But let's think about this year, for example. You know, looking back at the last couple of years, the particular tech market stock prices got really, really high, and then boom, 2022 happens. Stock prices for growth tech stocks are down much lower. So you're looking at those shares that you had that were once worth, $60 a share, and now they're $40 a share, $30 a share. In some companies, Peloton and a few other, over 70% decline over the last couple of years. But you're looking at your portfolio and you remember when you logged into your account and it said you owned big dollar amount, and now it's half that. Your bias in this case may prevent you from acting rationally on what to do with those shares now. How long are you willing to wait till that price goes back to those highs? And what kind of impact does that have on your financial plan? What kind of impact does it have on your financial plan if you're right? If you're right, then hey, great. That likely means that hopefully you can achieve the goals you have in your financial plan, and that roadmap going forward is smooth. But what if you're wrong? Does that mean you're going to have to make material changes to your lifestyle, to your retirement date, what you're going to cover for your kids' college, or if you're looking at doing a second home? Does this prevent you from doing that if that price does not recover? So I think there's a lot of hindsight bias when it comes to these. In most examples, stock prices here, you have to ask yourself, what changes are you willing to make if you're not right? Because it could have a big impact on your plan. And that's where having an objective person in your corner can kind of help you think through this of when should you stick to that hindsight price, or when is it time to consider other options and what adjustments may need to be made.
Yeah, this is again where having some written rules around an investment strategy, when certain things happen, you do this. That can take the emotional aspect out of the decision. It can, or at least limit it, right? You're still going to have emotions around the decisions, but it can help you make a more thoughtful, evidence-based decision based on the rules that you put in place. So as we move into our next bias, we're talking about naive diversification. And I think this one technically, or probably typically, occurs when people are busy and they don't have enough time, or maybe their knowledge is not deep enough to where they want to go into researching options, and they'll just scattershot in their 401k, right? It's like, I'm just going to put a percentage in each of these funds and hope that satisfies what I need it to and helps me reach the goal that I'm looking for. Right, Cameron?
Yeah, absolutely, man. It's business. And you get this email from HR about enrolling in your 401k, and you're in the middle of doing something. You're like, okay, let me just do this real quick. And, you sign up for the 401k, and they give you a list of 20 or 30 fund choices, and you scattershot 5-10% here and there, maybe a little more than that, over 5 or 6 funds, and hope for the best. It looks like it's going to be diversified, which you've always heard that you should probably be being diversified. So you think that you're good to go. Maybe a year or two later, you think about it again and realize that, maybe I don't need to be split between the S&P 500, the growth fund option in your 401k, and you might have even thrown a target date fund in there. It's just all scattered around, and you may be paying more as an expense ratio of these funds because of it. You may be just being a little inefficient on what you're invested in, or even you think you're diversified, but in reality, not really. And sometimes it just takes, a second set of eyes to look through the options to go down the path with you. And I've seen it many times. I've set up 401k plans for a few companies, and, I'll look at the participants in the plan, and we'll give them the education on, hey, use target date fund or whatever it is. But then I'll look at the participants, and there may be 10 fund choices, and they said 10% in each one of them. And, it's kind of that naive diversification, when it comes to the 401k, because I think a lot of people can relate to that. Most folks have a 401k or a retirement account of sorts, but it also makes me think of a few other areas, such as not having to have all of your cash at one bank. You want to spread it across 5 banks, and it may only be, a smaller amount of your overall wealth, but you still want to do that. Or custodians with investment accounts. I've seen folks that, should I have all my stuff at Vanguard, or should I move it between Vanguard, Fidelity, T. Rowe Price, and whoever? And it's a little bit of like, okay, that's diversified, I suppose, but doesn't need to be that way. And even on getting too far down the path of diversifying your type of investing or type of income, and thinking that, okay, my bulk of my investments are in the stock market, I need to go out this year in 2023 and find a rental property. I need to find a side hustle. I need to do this, that, and the other, just because it makes you think you're diversified. I think that's getting too far off the path of what do you need to do for yourself and your money to have a successful financial plan. And does having that rental property do anything to the success of your plan? Or does having multiple banks or custodians or investments in the 401k change the way your financial plan is set up? Most likely not. I think there's times where it's warranted to think about some diversification in that manner. What we're focusing on here is that behavioral of just thinking you need to be diversified for the sake of doing it, and then in reality you may not even be as diversified as you think you are. So think about what your goals are, what your financial plan looks like, and the decisions you make with your investments and your finances, do they support what you want your ideal financial future to look like? And then I think you can get more honed in on actually being properly diversified.
Yeah, it's having a purpose behind that diversification and realizing that true diversification means you're always going to hate something in your portfolio, that you're never going to love everything because something's going to be down and you're going to second guess what you should have done. That means you are diversified and you are allocated in different markets across the world so that you can benefit from the overall global output of success, prosperity with companies producing profits around the world. So that can set you up for the wealth journey that you're hoping you're on and going to reach the goals that you have in that plan. But this last bias, this one is the one that often is the biggest hamstring pull of your investment strategy. If you want to take it to the sports reference, that can just stop you in your tracks. And you don't realize it necessarily right at the time of how serious of an injury it can be. You try to fight through it, but you're realizing you're just going out and looking for the same things over and over to try to support this idea. And this is confirmation bias. It's the act of seeking out information that reaffirms your preceding belief about an investment or an outcome, and basically ignoring contradictions to that belief, not considering other things that could go wrong with it. Right, Cameron?
Right. And that's, we've got access to more knowledge and information than we ever have had before. And it's relatively easy and especially when you're looking for something to support your beliefs or, what you may have heard from a colleague or whoever it is. It's, this confirmation of a certain thought, and that may lead you down the wrong path with your finances. It may be a confirmation of, the stock market's going to crash. I need to get out. I need to sell my stock. I can't afford to lose money at this stage of my life. I need to get out. And so, first thing, Google search, is the stock market going to crash? Is a recession coming? Whatever it is. And you start confirming your beliefs. We kind of go back to that question of, well, what if you're right? What if you're wrong? And what does that do to your financial plan? And it can have a, devastating impacts in some cases, that you were able to confirm your beliefs of something's going to happen, but it really hinders the rest of your financial plan. Or, I'm thinking of books and podcasts, and you go down thinking that, well, investing in one index fund is the best strategy for me, and I've read books and podcasts and done everything to support that. Or something else, rental properties. That's the only way to true financial freedom and security is having real estate. And you could go on and on. There's so many. Yahoo Finance the other day, it was like 2 articles, and one of them said by the end of this time next year, Bitcoin's going to be at $5,000. And the very next article said Bitcoin's going to be at $250,000. And it was 2 individuals saying those separate things. And depending on who you follow, and you may believe one of those 2 things. And that's where recognizing that maybe you're just confirming your bias there. And is that going to help you achieve your goals and your financial plan? Is it going to mess you up? Is that going to be a devastating setback to your financial future? Ways to fight that, ask yourself those questions. What if I'm right? What if I'm wrong? But also seek out opposing viewpoints. Seek out historical data and information. Don't rush into things, as we've talked about in this podcast as well. Take your time. Does this align with your investing principles when making these decisions? It may be hard to recognize your confirmation bias until it's too late.
Yeah, we're going to find out actually how many people are listening to the podcast at this time, because it reminds me of the lyric from Ice Cube, check yourself before you wreck yourself, right? And this is what that is all about, is understanding what kind of mentality are you approaching your investment strategy with. Have you thought through and written out a financial plan that can guide you and get you to the place you want to be when you want to get there? That is another key behind this, right? And many times just having a second opinion can help you do that. But this stuff is really difficult. It takes courage to seek out things that oppose the view that you already have about a certain topic. And like Cameron said, there's rules of thumb for everything in financial planning, to where you could find a rule of thumb that probably would check the box and say, okay, I'm doing what I need to do on this front. But many times it may be that you're a little late in the game on saving, right? We'll often see people, and working with them for a couple of years, they'll say the comment, I wish I would have come here earlier, right? And I bet every financial advisor out there hears comments like that all the time, right? But it's difficult to take the time out of your normal everyday to reach out to a financial advisor. It's difficult to organize all your documents and get them and upload them into a digital file, right? And it takes time to schedule these meetings, and you don't always feel like motivated to do that because you're not sure you're where you need to be. But the sooner you can do something of that nature and just get a second opinion, if nothing else. But it could be that you need an accountability partner to work with you and make it a collaborative process on your wealth building journey. And that's why we do these episodes, to give you some ideas, some food for thought, to see where you are in your financial journey, in hopes that it will get you closer to the ideal retirement that you are seeking, and whatever that looks like. Hope you've enjoyed this episode. We've got over 175 other episodes and some YouTube videos that normally accompany these podcast episodes. You can check us out there, or at financialsymmetry.com. If you're interested in sitting down with one of our advisors, you can do that for free to talk through how this would look in a relationship, a long-term relationship. But we always appreciate you listening, appreciate your feedback, and we're looking forward to a few changes that we may have with the show in 2023. So I hope you'll stick with us if this is your first episode listening to us. And if you've been with us for a while, send us your feedback, but hope you like the changes that are to come. We'll talk to you again in 2 weeks.